For 12 consecutive months, foreclosures have been on the increase. They've been jumping pretty high. FHA delinquencies are now above 11%, and the president signed an executive order to stop institutional investors from buying foreclosed homes because someone in Washington remembers exactly what happened last time. So let's take this all in together, all right? Wall Street made billions off the last housing crisis, not by surviving it, but by buying it. At the bottom, when price was at its lowest and distressed homes were at their largest amount in modern history. They showed up with cash and they swept entire neighborhoods. Blackstone spent $150 million a week buying foreclosed homes at the trough. Everybody remembers when that happened, but very few people took advantage of it. 48,000 homes across Phoenix, Atlanta, Tampa, Las Vegas, which were all the hardest hit markets. One transaction after another at 60 cents on the dollar of estimated value. The federal government didn't just allow it, they organized the auctions. Batch sales that let Blackstone buy dozens of similar homes in the same suburb in a single transaction. They provided a $1 billion loan guarantee to encourage the buying. The same government that watched the crisis happen actually helped Wall Street profit from the bottom of it. And I got to be honest with you, I think most of you would agree. Let me know. Type yes or no down below if you wish you had been prepared with cash on the side. It's a big deal. The families who lost their homes in 2009 and 2010 became the tenants in 2012 and 2013. The same houses, but different owners. One woman's rent started at $1,850, and 4 years later, she got a notice over $3,000. She couldn't make it. She moved in with relatives, her daughter too. Blackstone took it public as Invitation Homes, a company that was created in 2017 for the public. They were around doing all of this buying up during the trough. They cashed out in 2019 for $1.7 billion. This is disgusting, but it happens every real estate cycle. The last one was big. I believe this one's going to be bigger. The crisis was the raw material. The displaced families were the revenue stream. The return was extraordinary. Now, the conditions that made it possible are forming again. FHA delinquencies are above 11%. FHA is the entry-level mortgage, first-time buyers, small down payments, lower income households. When FHA cracks first, it means the most financially exposed homeowners are the ones breaking. And that's exactly how subprime looked in 2006. A different name, same structural position in the market. 12 consecutive months of year-over-year foreclosure increases through February of 2026. And I'm going to throw this out there. If you want to take advantage of this situation, because somebody's going to buy up these houses, either it's going to be Wall Street, Blackstone, BlackRock, or your pension fund, or it's going to be you. I'm going to throw a link down below to the tax lien and tax deed course, the whole project. And if you really want to take this serious this year, I highly suggest looking into the group coaching calls as well. It's a whole system to be able to go to these auctions and pay even less than the foreclosure auctions. Foreclosure auctions, you're buying properties up between 50 to 70% on the dollar, right? 50, 70 cents on the dollar. Tax deed auctions, you're paying 10 to 30 cents on the dollar. So totally different game there. But sorry, I digress. Let me keep talking about this. We've seen massive increases in all of this stuff, right? Foreclosure filings in 2025 hit 367,000, right? Right now, 1.2 to 1.6 million homeowners are seriously underwater currently. That's how serious we're at. Their loan balance, at least 25% above the current market value, because home prices have been on the decline since 2023, actually quarter 4 of 2022. Most people don't understand that, but they aren't seeing what's right in front of them. You see, underwater homeowners can't sell or they can't refinance. They are waiting for something to change. There's a neighborhood in Cape Coral, Florida, that's called Gator Circle. If you drive through it today, you'll find unfinished houses every block or two. soggy work permits rotting in display cases, coffee cups abandoned on walls like, workers stepped away and never came back. Private credit funds lent money to doctors, physical therapists, and anyone who wanted a piece of the housing boom. The market turned in the last few years and loans are going bad. Matter of fact, they're so bad, these big funds, even including BlackRock, are limiting withdrawals from those funds. 547 properties in some stage of foreclosure or pre-foreclosure in just Cape Coral, right? This is 18% of visible inventory in a single city. 27% of homes purchased in Cape Coral in 2023 and 2024 are already underwater. Austin, Texas, 18% of 2022 vintage loans are underwater. Louisiana state, the whole state, at 11.9%. These aren't national averages. They're places where the most buying happened at the worst prices. Florida has the highest foreclosure rate in the country. Illinois is second, Pennsylvania third, and New Jersey fourth. States where insurance costs have spiked, property taxes are high, and the gap between what homeowners owe and what their families are worth has compressed the hardest. There's a CEO, his name is Rick Chagra, I believe that's how you pronounce it, of CJ Patrick Company, put a number on it. Said FHA delinquencies account for 52% of all seriously delinquent loans right now. Remember, FHA, that is your low tier borrower, a borrower it's an entry level loan. These are people that are not highly educated, and I'm just calling it out for what it is. They're not highly educated in the real estate cycles, how those work. They're not highly educated when it comes to loans. And so they are the ones that are at delinquency right now. So they may pull the trigger, just like we saw in 2008, and bail from their house because they're seriously underwater. See, he goes on to say, the CEO, that we're likely to see more FHA loans in foreclosure in 2026. Moody's Analytics put the recession probability at 49% just recently. If that converts, the foreclosure trajectory doesn't hold flat. 12 consecutive months of increases become something completely else entirely, actually. There's a house on Sandy Lee Way in Sacramento, California. It was bought in 2005 for $302,000. It was foreclosed on in 2012, right? Invitation Homes, remember the company that BlackRock or Blackstone created, acquired it for $150,000. So a little bit less than half price. They did this in 2017. They bundled it into a security offered by Wells Fargo. The previous owner's loss became a financial product that paid investors a return. You see, that's the mechanism. It's not a scandal, it's a structure. Crisis, it becomes a discount when we're talking about real estate. Discount creates acquisition, and acquisition at scale creates an asset class. The asset class generates returns. See, the structure doesn't require bad intent, but it requires a foreclosure wave and a buyer with cash. And that's why it's important that everyone watching this is building up cash for this event. You see, at foreclosure auction, the winning bid averages around 60 cents on the dollar, like I said before. If you go into tax deed auctions, oh my gosh, it's so much better. You're paying 10 cents to 30 cents, right? But a lot of people focus on these foreclosure auctions. That's what we're talking about today. The cash buyer that buys those captures 40 cents of discount before a single renovation dollar is spent, right? A family trying to buy at auction needs financing, and financing needs time and down payment. Auctions don't wait. The institutions with pre-approved capital and a team on the ground wins before the individual buyer understands the terms. The truth is, that's why I'm teaching people about tax liens and tax deeds, because nobody understands that. It's one of the most misunderstood investments with the greatest returns in the country when it comes to real estate. So if you want, I'm going to throw that link down below, and it could change everything for you. These numbers in the foreclosure industry are not going down anytime soon. Rates are only going up because the 10-year bond is rising. As we're looking at geopolitical risks, the whole world is fracturing, and we're seeing issues in the stock market as well. The Fed can't lower rates because inflation is too high in everything from, food, gasoline, rent, everything. So they can't lower rates. They actually have to raise rates, which is going to exacerbate the problem. There's a lot of opportunities out there. You just need to be able to know which one to take advantage of. All right, with that being said, the real estate ninja or the economic ninja or the ninjas ninja, I don't even know where this is going, is out.